Hi, everybody. Good morning, good afternoon, and welcome to the second part of this webinar series on raising non-dilutive capital. I'm Charlie Graham-Brown. I'm going to be the host today. I'm one of the partners and the Chief Investment Officer at Seedstars. And we've got three special guests that I'll introduce you to shortly who are going to really be the experts on the topic of raising off-balance sheet financing, and they're going to be here to talk to you shortly. So you may know a little bit about Seedstars, you may not. So just very quickly what we do. On one hand, we have Seedstars community, where our goal is really about accelerating developing market ecosystems, so tech and startup ecosystems, through various different programs, all the way from hackathons, acceleration programs, expansion programs, and everything in between. On the other hand, we have Seedstars Capital, which is our investment platform where we make equity investments into early stage companies all across emerging markets. Today, we've made over 75 investments. And as part of that portfolio, we've come to realize that a lot of companies are looking to raise debt. They need to raise non-dilutive capital. And there's often a lot of misconceptions or questions around how to best go about doing that. So we decided to put on this webinar series. It's going to be across 7 parts now, where we've added one final one at the end of this list. So last week we spoke about on-balance sheet financing, and you'll find the video on YouTube if you're interested to watch that. Today we're going to be talking about off-balance sheet financing. And then from there, we're also going to cover revenue-based financing next week, crypto lending, grants, venture debt, and at the end, we're adding on another one called impact-linked financing. So today for this session, I am really delighted to welcome 3 individuals. So Bernhard from CIM, Yusef from Graviti, and Gustavo from RedCapital in Chile. I'll introduce you to them as we go, but basically throughout this session, we're going to talk to them each for about 10 to 15 minutes. You're going to hear first the investor's perspective from Bernhard, and then we'll hear from Yusef and Gustavo, really the entrepreneur, the founder, the startup perspective about raising debt. So let's jump straight into it. I will first invite Bernhard to join me. So Bernhard is the head of emerging markets for Community Investment Management, or CIM. Bernhard started his life with JP Morgan, or started his career with JP Morgan. And then actually we coincided together at Blue Orchard briefly. And I went down the Blue Orchard route, and Bernhard went down the Bamboo Capital Partners route. He spent about 10 years with Bamboo. For those of you who don't know, Bamboo is really what I would consider one of the pioneer impact investors, private equity focused in emerging markets. And Bernie spent actually 7 years in Bogota, so really got to know the LATAM market extremely well, and has also sat on boards of some pretty successful fintechs. Some of you might know Lydia from Nigeria, for example. And last year, so I think just before the crisis, or as it was starting, Bernhard, you joined CIM to head up their emerging market strategy. And I'm going to hand it over to you to tell us a little bit about what you do and how you look at off-balance sheet financing.
Thank you, Charlie. And good morning, afternoon, evening to all of you. And a pleasure to be here for the seminar on off-balance sheet financing. So as Charlie said, I now work for CIM, Community Investment Management, where I'm a partner for their emerging markets fund. CIM started about 8 years ago in the US and is an impact investor that provides credit or structured credit solutions to fintech platforms that focus on financial inclusion. We've funded about $1.5 billion in credit to date to those fintechs, with the vast majority going towards small and medium-sized business funding, but we've also done other verticals in the fintech sphere. About a year ago, as I said, I joined CIM to take that methodology to emerging markets again, because the background of the founders of CIM and my own background has been in emerging markets mostly. So now we just launched in June a new fund dedicated to providing credit to fintechs focused on inclusion in emerging markets. And so what I wanted to talk to you about today is a little bit off-balance sheet financing, and I will mostly refer to it in the context of what lenders, alternative lenders or fintech lenders, when they are using off-balance sheet financing. So what is off-balance sheet financing? Off-balance sheet financing is basically debt financing that's outside of your balance sheet, backed up by an asset or several assets. So in my case, it's mostly by a loan book, and that's typically housed in an SPV, special purpose vehicle, or trust structure, depending on the jurisdiction, that creates a bankruptcy remoteness between the company, so the lender, and that SPV, right? And what that really means is that the assets that the SPV is financing, so say a loan book, and the right to collections from those assets have effectively been transferred to that SPV. And they have been segregated from the balance sheet of the assets of the originator or the issuer, right? And the big point here is that the transfer of the assets into the SPV cannot be unwound by the company or its creditors in case of a bankruptcy, basically, right? So that's what OBS typically refers to. Why do companies do that? Well, it allows them to reduce their debt exposure on their balance sheet, so their leverage ratios. It usually means that they can get access to lower funding costs. It can be more easily available at an earlier stage, and that's mostly because many companies at an earlier stage are not yet profitable, and so when you set up an off-balance sheet funding facility, you may be actually able to get funding that you might not get directly from your balance sheet. And it also allows you to clean up your balance sheet in some cases, especially in the case of when you're doing asset leasing off balance sheet. For investor, what does it do? For investors, it basically gives them usually a higher credit quality, so better credit quality exposure than lending directly to the balance sheet, because, as I was mentioning, often earlier stage companies are not yet profitable. It allows you to ring fence your position, your senior creditor position, by defining exactly the assets and only lending against those assets that you will finance. And it also separates you from being in a situation where you're pari passu, so on same terms as other creditors to that company, and where you might get stuck in a web of cross defaults or covenants being triggered by other funding facilities that the same company might have on their balance sheet. And last but not least, there's a lot of flexibility to customize your facility according to what you would want, specifically in terms of what the collateral is like, and you can build in all sorts of extra credit enhancement features. So it's really a win-win in many ways for both companies and investors. The use case, as I was mentioning, is typically for receivable financing and for leasing, and the requirements to borrow vary according to jurisdictions and the specific sectors. But I would say the most important part is to have a financial markets maturity that is apt for providing asset-backed lending services. So that means that there should be some basic laws on securitization of assets. There should be some availability of service providers in the asset-backed or in the off-balance sheet lending ecosystem, which means specifically fiduciary parties or backup services and things like that. And so the most important part is to have a legal environment and a regulatory environment that allows you to do this kind of transaction, and to have also the expertise either provided by an external counsel or in-house on how to structure this. What are some of the most important terms here that you will find when you're doing an off-balance sheet facility? So obviously size is a big one. This is one of the reasons why companies like to do it. It gives them access to basically larger funding facilities than an on-balance sheet loan would be. Very often these are designed to be really large and have the ability to scale into them, where both parties, so the lender and the borrower, have an incentive to scale. Pricing is obviously key, and pricing will usually be an interest rate component, but there might also be fees like upfront fees or commitment fees or disbursement fees. So this is very important to understand what you need. If you focus on a committed facility, then you might have to pay slightly higher fees for that. But there are several types of fees that you need to be careful when you look at this. The next piece is really the most important one for a lender like ourselves. It's the guarantee, the credit enhancement, and there are several elements to this. The typical one that you would see is the advance rate, which means that, how much of your own skin do you put in the game? So if I provide you a $100 loan, will you put a $10 or $20 or $30 equivalent yourselves also into the structure, which is subordinated to to my portion. So it's called the advance rate. But you'll also build up other structural features like reserve accounts and other mechanisms to provide some sort of additional margin here. I'd say the other things that are important for you to look at is the recourse guarantee issue. So some lenders will not only want to have the ring-fenced assets in the SPV, but on top of that might want the company to provide an additional guarantee to the SPV, right? This is usually the case when you're very early stage, or it's not been de-risked yet, or it's sort of a first of its kind transaction, or for the earlier stages of a facility, but that might be an additional feature. And then the last part that's really key in these off-balance sheet facilities is the waterfall. It's how you set up the payment hierarchy within the SPV. Once the SPV starts getting basically cash flows, right? So say it's backed by a loan book and customers start paying back. Well, then there's a very specific waterfall as to how you distribute the income that's coming into it, and that's very important that is aligned so the incentives are right for all parties and everyone gets paid. In terms of the main parties here in such a transaction, you have the company, which I call the issuer or originator or alternative lending company. You have the borrower, which is the SPV or the trust structure. Then you have the agent or the creditor, which would be somebody like ourselves, CIM. You might have a guarantor, so it could be another parent company of the company or that's providing a limited guarantee or a full guarantee. You have the trustee, the backup servicer, and other parties like verification agents. So these are part of the ecosystem of an off-balance sheet type facility. In short, I would say it's a structure that really is useful for companies as they're beginning to scale their business models that might not get yet institutional type funding to their balance sheets. It allows you to get a much larger facility very often, and for the lender, it's also very, very convenient because it mitigates credit risk significantly. Thank you.
Brilliant. Thanks so much, Bernhard. That's fantastic insights, I think, there, and a great summary. But just a few questions and things I'd love to discuss with you for a couple of minutes. So in terms of the tenor or the maturity of these kind of products, I mean, are they evergreen? Are they kind of revolving, or do you have a defined maturity date on them?
Very good question. I mean, you can design it as you like, but typically they have a defined maturity date to them. And so in our cases, what we'd have is usually facilities that have a 3 to 5 year investment period. So during the 3 to 5 years, the companies can draw down within the facility as much as they want and just pay us interest. And then you would have an amortization period of the principal, usually like within a year. But so often the tenor is revolving for 3, 4, 5, 6 years, and then a drawdown of a year or whatever the structure makes sense according to your needs.
And I assume the interest of CIM and other lenders providing these facilities is to roll it over and to re-up and increase the facility size as you go, right? Absolutely. Can you leverage the same structure, or you have to set up a new structure each time?
No, you can leverage the same structure, and you can also very often what happens is you see a master trust, and that then has sub trusts, and you can sort of add on to that if you wanted to expand to different product directions. But you can just change the terms. In fact, pretty much all of our facilities, unless the originators had some problems, have been extended at the turnaround.
Right. You mentioned something about jurisdiction and the rule of law, and there has to be certain laws around securitization. I'm looking in the chat today and I see people, Kenya, Thailand, Greece, Mozambique, Nigeria, Morocco. So there's a whole bunch of people all around the world. Where have you seen these facilities working, given the regulatory environment, and where are they challenging to operate?
I think, the safest bet for investors from our end are the more liquid capital markets in middle income country at this point, as they already have the degree of depth and institutional maturity, where you have quite a few precedent cases for this. So, specifically talking India, for example, Mexico, Colombia, Peru, Chile, Brazil. These are all countries that already have existing securitization laws and precedence cases. So these would work very well. But there are many others too. So South Africa, for example, has quite an active securitization market. You would find structures easily in Indonesia, in Philippines. So it is spreading across the world, and it is possible pretty much to do it theoretically in any jurisdiction. But I would just say that especially for some of the smaller countries, scale is a really important factor here because the legal costs around it to setting up these structures are very high. So this does not make sense if you're planning to raise $2, $3, $4, $5 million and not to grow that over time.
Right. You mentioned in terms of the use cases that generally this works best for loan book financing. I'm sure there are people viewing this who are in need of working capital, and I think for working capital, this facility would not be appropriate, and it's more the on-balance sheet lending we talked about last week, or revenue-based financing we'll talk about next week. But if assuming you are financing a loan book, this versus an on-balance sheet facility, they're really, is it really that easy of an option, or is it that easy of an answer that off-balance sheet is just far and above more advantageous for everybody?
I wish it was, but obviously it isn't. I would say that, I can give you just some concrete examples of companies that we're working with and what sort of level of scale they have reached before they started doing this. And you'd be surprised to hear that, we look at companies where we think this makes sense that might have originated something around 10, 15, $20 million in a loan book. And at that point, it might make sense to look at off-balance sheet structures. The point is obviously not what is your origination today, but where you might get with a structure like this. And it really does provide a lot of certainty and reliability to the counterparties to have the access to these facilities. So you have to look at it obviously case by case. Important is also the type of assets that you're trying to put into these SPVs. So if you have like a really, really short-term receivable of say less than a week, it gets trickier to do this legally, to structure it, because the rotation is so high. But generally speaking, I'd say once you have your MVP, you've proven your unit economics on a reasonable scale, and you want to really sort of grow it on a larger scale or nationally, then this is a good time to look at it.
Brilliant. Where do you see companies typically struggling in the process with you, and where are the pitfalls people should be aware of?
So I think the hardest part in this is the legal and the financial structuring. And with that, I refer to two things. So the legal structuring is hard because it will require a loan agreement under an international jurisdiction, so say under US law. And then on top of that, you will have the trust agreements under local law. So that is quite a legal lift. And we're talking probably another 5-6 agreements on top of that I didn't just mention, but that are ancillary to the ecosystem. With that, you're easily looking at 1,000 pages of contracts to be executed, and that is a challenge for all parties involved to understand and to execute and implement on. The other pitfall is, if I put my hat on as a portfolio company, is make sure that you're setting yourself up for success for the future, so that the restrictions that you're getting or that you might be having at the beginning, there are clear rules in terms of how to improve those or release those restrictions over time. So what you'd find is that you would have certain events like triggers or KPIs or requirements in terms of eligibility, concentration, and other factors, which would allow you to change certain conditions of the facility. I'll make sure they make sense for your business and that they're clearly defined, and that way you really have an incentive to scale into this. Because I've seen off-balance sheet facilities that never took off, and that's very often the case because the conditions are too restrictive at the beginning, and then there's no incentive to scale, and then you're just stuck with a huge amount of legal costs and never really grew.
1,000 pages of legal, that doesn't come cheap. So no, that's really helpful, really insightful. And I think, it's important to probably have someone on the team who's got that financial background, that financial knowledge, has worked with structured finance. And I think, we were talking about this last week, fortunately, with all of the boom and the 20-year history, I guess, we have in microfinance and the NBFC market, I think there are talent on the ground that, you could easily hire into these fintechs.
Yeah, no, for sure. And then maybe last piece there also is your IT systems. Data is obviously crucial.
Absolutely. Brilliant, Bernie. Thank you so much for the insights. We're going to jump onto the next segment, and then we'll see you back at the end for some more Q&A with the rest of the people watching today. Thank you.
Thank you.
Brilliant. So we're going to jump into the first segment here with the perspective from a startup and from a founder. And I'm going to welcome Yusef from Mexico, who's the founder and CEO of Graviti. Hey, Yusef.
Hi, Charlie.
So Yusef is a pretty interesting profile, and the first time I met him, I was quite struck by his story. So he's an engineer, but unlike most students, I think you learned at some point in your career that there were 200,000 households in Mexico without electricity. And rather than carry on studying, well, you did study on the side, you finished your studies, but you started installing solar electricity systems and solar lighting in these households. And you started off as a project, you flipped it into a first company, made a bunch of mistakes, and then you sold that company and started afresh with Graviti. So this is the kind of third iteration, I guess. And that was back in 2019. And I think things have been going from strength to strength. And now you're deploying about $1 million per month to 1,000 borrowers or customers, and really having a huge impact, focusing on a number of essential household appliances. So Yusef, delighted to have you with us today. Maybe you can start off telling us a little bit about Graviti, and then also the sort of debt facility you've been able to raise to fuel your growth.
Thanks for that intro, Charlie, and the invitation. Happy to be here and tell a bit of our story. Hope it can be of some help or worth for the entrepreneurs in the webinar. So yeah, I mean, you mentioned a bit of my story, highlighted that we made a lot of mistakes on our first company, which is super true. So yeah, don't worry if you're making mistakes. Right now at Graviti, specifically, we're a buy now, pay later platform focused in the low income unbanked sector in Latin America, and trying to solve a really specific problem and focusing on that problem. In Latin America, there are 100 million families that lack access to a single appliance in their household, which is pretty crazy. I mean, 100 million families that don't have access to these basic products. And the reason why they don't have access to these products is not that there are not enough retailers that sell to this sector population or enough products. The true issue is a financial gap, a financial problem, right? Since these families are low income, they typically cannot afford to buy, let's say, a refrigerator or a washing machine upfront. And since they're also unbanked, they lack access to credit. And at the other side of the table, merchants, it doesn't matter if you're talking about like a huge merchant, let's say a Walmart or a local hardware store, almost none of them offer financing to this sector population due to the difficulty of underwriting, payment collection, specifically in this type of customer. So what this generates is a huge gap, right? These 100 million families want to buy these products. Retailers want to access these products, but there are difficulties in both sides, right? And that's exactly where Graviti comes in. We act as a bridge between these two parties. What we do is we partner with merchants and retailers to enable them to sell their products to this sector population with loans or financing provided by us, by Graviti. So for the retailers, it's basically like Christmas. They can sell to this new huge market without having to worry about risk, payment collection, underwriting, because we pay them upfront, no commissions most of the time. And for the end customers, it's also like Christmas, because now they can access the products that they need the most with really accessible and fair financing provided by us. We see this, the financing of basic appliances, which typically is the first access to credit or loans our customer have, as the perfect way to start banking this type of customer. If we underwrite and we offer them financing to the product they need the most, and we do a good underwriting, what's most likely going to happen is that these customers are going to pay well for these products. And by doing that, we start building them a credit history that enables them then to get access to maybe first a second appliance or a third appliance, but once they build this credit history, we can provide them with additional financial services and really start building financial inclusion for this sector population. So we see asset-based finance, specifically for appliances, as a perfect excuse or first step towards financial inclusion for our customers. And that's what we are right now. Obviously, since we basically are a lending company, debt plays a big role on our business model, right? I don't have a financial background. As Charlie said, I'm engineering, specifically a physics engineer. So mostly a lot of these I had to learn by making mistakes, basically. So when we started first working at Graviti, we didn't even start lending ourselves. We first had like a three-sided marketplace approach, where we partnered with merchants, we acquired customers, and we partnered also with microfinance institutions that were the ones that underwrote the loans. So we didn't underwrite them ourselves. That started working for a while until we started to grow faster than these microfinance institutions could keep up, and basically we weren't their priority. They were underwriting their own loans. So we realized that we had to become a lending company and underwrite our own loans if we wanted to really offer our customers the best product we could. So we started to learn a bit about how we could do this. From our research, we basically landed on this structure that I'm seeing, which is basically the structure that Bernhard so eloquently explained a couple of minutes ago. I think he's a true expert. I don't see myself as an expert in debt, but basically this is how we operate. So we have an off-balance. Our first facility was an off-balance debt facility, and it worked exactly as Bernhard mentioned. So we did a structured debt facility that was subordinated. In our case, our debt facility had 3 layers, which I showed here. Our haircut capital that we put ourselves, which was 12%, which may be high, but it's pretty good if it's your first facility. This is basically what Bernhard was mentioning about the advance rate, right? So for each, let's say, $100 that we lend, we ourselves were putting $12 from equity, right, from our money. So that's the first layer. As you can see in this structure, as you move down the structure, there is more risk, but also a priority in payments. So, for example, we are from this facility the first one that get paid when customers start paying back their loans in the waterfall. Right. Then in the second layer, we have what's called a mezzanine debt that was provided by RedCapital. RedCapital was the first fund that invested in us in debt, and actually there are also the managers of this facility. They do the waterfall. They check the portfolio performance. They do the receivables, the legal part, the structure, everything. So they're the mezzanine layer. What that means is that they're the second ones that get paid on the waterfall, but also have like a pretty good protection of 12%. What this means is for RedCapital to have losses from the facility, we would have to have a higher default than 12%. All the losses up to 12% are basically guaranteed by our haircut capital, by Graviti. So that's why it's the riskier, the most risky part, right? The haircut capital. But that provides an additional layer of protection to the mezzanine layer, which is the second layer. And this is one of the things I like the most about this structure, because, for example, in our case, when we did this debt facility, we had underwrote less than $1 million. So we had like pretty little traction, a small traction. We weren't a lending company. We were starting to underwrite, and this structure allowed us to raise way more debt than we would otherwise if we hadn't used this structure, because it provides these like protection layers to investors, right? So that's the mezzanine layer. The third layer, which is the senior debt, basically is where other additional investors come in. Basically, institutional investors. In our case, it was joined by 2 institutional investors and also like individual investors. So this was like a bit of a mix between like basically friends and family and institutional investors. This layer is the less risky one and also the lowest priority in the waterfall. So they're the ones that get paid at the end, right? But this layer is the less risky because it already has like 2 protections around default, right? So a 12% and an almost 18%. So almost 30% of protection. I mean, this layer is almost guaranteed their payment and their returns, right? Only if Graviti would endure like 30% default would they endure losses, which is pretty low probability. I mean, almost impossible. If we were at 30% default, we would be in like deeper problems. So this senior debt is pretty well protected, right? Because they already have these additional protections. And that's like the layer where we get the highest amount of funding, as you can see in the structure. Basically, with this structure, we raised, a small debt facility, a 250K debt facility, but then we extended the same structure twofold. So we raised an additional 500K. Right now, we're on our fourth debt facility, which is a way higher amount. Right now, we just closed a 25 million debt facility with a similar structure, some differences, but basically a similar structure that's going to enable us to keep going. I think the biggest advantages of this sort of structure are mostly highlighted around early stage companies, as we were when we raised and as we are right now, because as I said, it allows you to raise higher amounts of debt, I think, that you would otherwise if you have low traction, because it allows investors to invest with really low risk, specifically senior investors, right? It reduces risk, as I said, for both parties also, because as Bernhard mentioned, all of the loans that we underwrite are off balance, and we hand over the receivables to the SPV. So even if, for example, Graviti goes bankrupt, for example, the senior and mezzanine layer are going to still collecting their payments, right? And it also allows less risk for Graviti because all of this is off balance, right? We hand over the receivables. That being said, I mean, I do think this type of structure and any lending for any startup has to be taken with a grain of salt. I mean, you really have to have an adequate business model to match with this type of structure. I mean, you either have to be, I think, like a lending company or a recurring revenue company, like really have predictable revenue in order to be able to raise this debt facility. Otherwise, you're not going to be able to securitize a loan book or receivables to hand over to the SPV. So it may be not, it may not be a structure like for all types of companies. Around some of the stuff that we struggled to do for this structure, as Bernhard mentioned, was basically the legal and financial due diligence, right? So this was our first debt facility, and the due diligence and the audit and the analysis of the loan book and performance and portfolio performance was really deep. So you have to be ready for that, and you have to be ready to invest a lot of time building an amazing data room that you can take to investors, and really have your collection policies, underwriting policies, manuals, everything pretty well documented so you can present to investors. So for example, this I think is way harder to raise than equity, for example, because here you're not selling a dream as you're selling with equity, right? And the future dream. Here you're selling like actual revenue that you are going to have to execute, right? So it may not be for every type of business or every stage. It has worked pretty well for us, obviously, because we've raised other 3 debt facilities in this same structure, but it may not be for all. But yeah, that's a bit about the debt facility we use. Basically, it's the same structure that Bernhard mentioned, and it has been a pretty good match for us as a lending company.
Brilliant. Thank you so much, Yusef. You've answered a ton of my questions already. And I think the concrete example on top of all the explanation Bernhard gave is just perfect. So I hope now for everyone watching, it's becoming pretty crystal clear how this all works. Just would love to understand from an operational standpoint and a team standpoint, for you guys to go from a company where you started off, I think that was a great hack as well, working with external microfinance companies. They were the ones doing the underwriting. to go from that to doing your first facility and maybe the second facility, in terms of infrastructure, whether it's IT and the data side, or whether it's human resources and people who understand the securitization and I guess sort of financial experts, what changes did you have to make, or talent did you have to bring on board?
Yeah. So locally around our infrastructure and our platform, there weren't that many changes, because the way we've built our platform and our whole marketplace, as I mentioned, enabled us to enter the Graviti platform as if we were one of the microfinance institutions that join our marketplace, right? So you have a three-sided marketplace. There is the customer, the retailer or merchant, and the microfinance institution. So we build all of the connection between those, right? How do you pay each one? How do you receive payments? How do you sell the products? Everything, right? So when we started doing this, we have almost 5 microfinance institutions that we were working with. And as I mentioned, it was pretty hard to scale with them, because this was just one of the products that they were doing, and they weren't prioritizing our loan book. They take too much time. We couldn't automate a lot of the underwriting because we have to adapt to their processes. So we started thinking if we want to deliver the product that we have in mind, that we know our customers want and need, we have to do it ourselves. Locally, the way we designed this infrastructure on our platform enables us, as I mentioned, to join the Graviti platform as if we were another, just like a plugin. So that was like a lucky coincidence. So we just plug in as a microfinance institution on our platform. Even still, our platform still works as that three-sided marketplace. We're just the only microfinance institution in the marketplace, right? But so that worked out pretty well. But on the talent side, it was where we started to struggle a bit more, and where we had to adapt way more. So as I mentioned, I don't have a lending or financial background, and that maybe is some of the key things to acknowledge as an entrepreneur, which are your consultants that started helping us structure what it could look like for us to be the underwriting. And actually, one of those consultants that is a CFA and has done this, Arturo, which is right now our CFO, has done these structures in the public markets, private markets, hundreds of millions of dollars worth of these structures, and does this in his sleep. Joined Graviti as a CFO. When we raised our fourth facility, the one that we just closed, we added our chief risk officer, which is Conrado. He was previously a senior VP of risk in Misoho Bank. So as we've been moving forward with these facilities, the loan book, the raise that we're targeting was bigger, and the debt facilities are a bigger structure. We've been complementing the team at the executive level and also on the operating level. Okay. So yeah, we do have had to adapt quite a bit around talent there. Yeah.
Super. Thank you so much, Yusef. Really insightful comments there. And we're going to jump into talking with Gustavo now, and we'll see you back at the end for some Q&A with everyone else.
Thank you, Charlie. Great to be here.
In a minute. So the final entrepreneur and founder I'd like to bring up to chat with us is Gustavo from RedCapital in Chile. Hey, Gustavo. He's not here yet, but he'll be here in a sec, hopefully. So Gustavo may have internet connectivity problems. Let's just give him a sec and see if he can join. If not, then we will. Here he is. Hey, Gustavo.
Hello, how are you?
Hey. So, Gustavo, thank you so much for joining us. And maybe just let me quickly introduce you. So, Gustavo, like I mentioned, from Chile, another engineer. You worked, Gustavo, with an industrial companies to start with, and some telcos, then also in the department store industry. So you've had experience in a whole bunch of different sectors. And I noticed a lot of your experience was on the customer service side. And I think that's where the attention to user experience at RedCapital comes from. But anyway, 7 years ago, you saw the gap in the market for SME financing, and you started building RedCapital with your founders. And today you've now scaled that loan book to about $60 million, which is incredible and fantastic growth you've accomplished. You're operating not just in Chile, but also in Colombia and Peru. And delighted to have you here today. And what I would love for you to do, Gustavo, is maybe just tell everybody very quickly what RedCapital does, but then focus a bit more on how you've financed your loan book and the types of facilities you've been raising.
Excellent, Charlie. Thank you very much. Maybe we can go to the next slide. RedCapital is a funding platform who focus on lending and invoice discounting to SMEs. We're one of the leading companies in Latin America, offering best-in-class technology and customer experience. As Charlie say, my previous experience made me focus on trying to give the SMEs the best experience when they require a loan. So now, thanks to technology, SMEs can know in 1 minute if they're good or they're able to get a loan from us. This is very important for us because we have also a social role. We're helping SMEs that don't get the money they need in banks. That's a common problem in Latin America and I hear in other parts of the world. So with RedCapital, well, helping them to get the money they need, and also we're helping them to build financial capacities. Because the SMEs, as I said before, in 1 minute can log into the platform and get a lot of information they need of the sales, of the problem of the customers, etc. We have a leading position in this huge market of SMEs that don't get the money in banks. We're thinking about $50 billion is the credit gap to SMEs. We have shown, as Charlie said, that we have the capability of getting to those SMEs that don't get the money. And until now, SMEs have received more than $300 million in loans through RedCapital. And the best of all is that they have less than 1% of default record. So that's very attractive for the investors because they know that this segment that usually don't get the money in bank don't necessarily are more risky. We have been growing more than 100% per year, so that's very important to keep the risk low. And the return to the investor is on average 10%, so per year. So it's very attractive to help these SMEs thanks to RedCapital technology. So how can we lend this money? The problem is that when we started, we didn't have money. So we know the problem. The SMEs don't get the money they need in banks. So how can we help them? We decided to start with the crowdfunding platform, RedCapital. So at first, we publish the customer that apply. They go to our risk model, and if they're approved, we publish them on the platform. And then each investor chooses the loan or the invoices that they want to invest in. So that's how we started. And then in 2016, we were able to have the first agreement with a fund, and they will like to invest mainly in loans. So we started with them. We have the track record, the very good track record, and we showed them that because funds usually like to invest in bigger loans, to bigger company, because the cost for them to invest in a bigger ticket, for example, in $1 million loan, is the same cost for them that to invest to a $10,000 loan, because they have to, study the case, and then they have to collect the money, etc. So thanks to RedCapital and thanks to technology, the funds knew that they can invest in smaller loans, and they don't have to get more people to analyze this operation. The terms of the loans are usually a bridge loan, a short term, from 6 months until 3 years. And we started with loans with some assets or guarantees, like property, mortgage, something like that. And then we with the time, the funds get to know that we have very good track record also with other funds. So it's not just crowdfunding. It's now the funds knew that they have products, they can lend money to other people, in this case to SMEs, and they get a very good return. So then it was easier for us to go and looking for new funds to help SMEs. As I said before, when we started, we have like 100% retail investors through crowdfunding, and now mainly we have funds working with us, like 56%. And as Charlie say, if we look the loan book, because funds usually go to a longer term than the retail investor. So in the loan book, like 90% is our funds. With the funds, we have different terms. Each term depends on the type of loan. If it's a loan with a guarantee, is a leasing, or is a invoice discounting, depends on the rates. For example, we have invoices that go from 0.44 per month to 2% per month, but they're usually in invoices counting, they're short term, from 1 month to 4 months duration. In the case of the loans, they're usually from 6 months to 2 years. And there we go from zero to 1.5% per month. For example, we have an alliance with Anglo American. It's a mining company in Chile, and they're helping micro businesses with loans with a 0% interest per month. So this is a way that they can help micro businesses. Thanks to technology, it's very easy for the customer to apply to the loan, and they decided what are the kind of companies that they want to help. How much would be the sales of the company, the kind of business, where they should be located, etc. So we have different types of funds, and also in Peru we start with one fund, then second, and then when you have a track record, it's easier for us to go and knock on the door of the next fund, and we need to continue to raise money because we wanted to grow more than 100% per year. So to keep growing more than 100% per year. So each year we need more money to keep helping SMEs. So that's the way. I don't know, Charlie, if you have any doubt.
That's super. Thanks so much, Gustavo, for the insights. And I think, again, you've been very innovative in figuring out how to finance that loan book from day one. So I assume crowdfunding, it generally comes under different laws and regulations. There's, I think most companies, right, they have crowdfunding rules and regulations you have to follow before, you moved into that second step of raising debt from institutional investors. But no, thank you so much, Gustavo. We are getting close to the end of the time. So what I'm going to do is ask the others to come back in as well. And everybody watching, feel free to start asking questions on the chat. I see already a few coming in. And Gustavo, maybe I'll just start off with one question for you, and then I'll start reading what's coming through the comments, and we can take it from there. Gustavo, going forward, as you think about the sort of mix and how you want to scale this company, and obviously you'll need to continue raising debt, are there other instruments or facilities you're thinking about, or other types of lenders, and how do you make sure you have enough diversity within the relationships you've built for these debt facilities you're raising?
Yeah, now that we have more track record, we are looking for also a balance sheet lend. So this is an alternative we want to look at. We know that we can get money from banks because banks don't understand startups. They don't understand that we need to burn money to grow because we have a 3-time lifetime value compared to cost of acquisition, customer acquisition cost. So that's banks don't understand. So if I go to the banks to ask for money, even though we have been growing more than 100% per year, we're in 3 countries, etc., they don't understand it, and that's a problem. So we have to look at funds or partners that like CIM, for example, or something like that, because I think that's the way to get the money we need. Also, we want to raise capital, equity, but the equity is mainly, in our case, to grow, to invest in technology, to invest in people, in marketing, to get more customers.
Brilliant. Thanks so much, Yusef. So there's a couple of questions from the chat. So there's one from George here for you, Bernhard, and really asking about how to finance machinery and what sort of funding you think you would best go after.
It's hard to say without knowing more context about what stage your business is in and what kind of machines we're talking about. I mean, I would say if you're an early stage startup with just a prototype, the normal funding sources of that include friends and family, and local people, family offices, or local angel investors. One thing though that we see, what I think you see increasingly to do with asset finance, is that the asset distributors might actually have a financing option for you. They very often team up with alternative lending companies that might be able to give you financing for this. But I would say it's going to be hard for you to get international funding for that if you're at the prototype stage. I would look locally.
Absolutely. No, I would agree with that. Thank you. There's another question from Alejandro, which Yusef, I'll ask you to take a crack at. So I guess, the question about the time and the effort and the legal, we talked about a bit, but you can touch on that. I think there's also a question from the customer's perspective and whether, having this off-balance sheet facility changes their user experience and the flow.
Yeah, so I mean, Alejandro, you're right on point there that working with trust are slow, bureaucratic, and hard to manage, and also expensive. It can be pretty frustrating. I mean, for the end customer, it doesn't really have much impact if we as a company do our job well. So what we have to do is to try to automate or have every one of the processes like in place that we do with the trust. So for the end customer, the underwriting can be done automatically thanks to our technology. Their payments can be reflected automatically thanks to our technology. Maybe for investors around the senior debt or the mezzanine debt, sometimes the waterfall could be slow or bureaucratic for them when they do the payments waterfall. Then customer doesn't really have the impact. The ones that have most of the impact is ourselves as a lender or the startup, because we have to build all of this structure with the trust that can be expensive, can be slow, and we have to adapt to their processes, and that can be frustrating. So I think there's a lot of room there for innovation and disruption of enabling better ways to work with trusts. Actually, maybe in the future is a product in another world or that we launch at Graviti or in a different company, because there is like a really interesting opportunity there for a fintech that can disrupt the market to do these processes that right now are done by trust really traditionally with the use of technology. Yeah, that's an interesting thing to think about.
It's for your next life, Yusef.
Yeah, exactly.
And anybody watching, feel free to ask your questions in the comments, and we'll pick up on them and ask whoever you direct them to. I have one question for you, Bernie, which so I always find it fascinating. You know, we're talking here about the end borrowers or the end beneficiaries. So, you know, individuals in Yusef's case or SMEs in Gustavo's case, capital coming in from CIM or others. But where does your capital come from, Bernhard? And what do you guys have to promise your investors?
Good question. So I would say, I mean, in the case of CIM, we have a pretty broad investor base. Our capital comes from now close to 150 investors, and that really ranges from high net worth individuals to institutional investors. But the bulk of our funding is from family offices, I would say, and also but we have pension funds, foundations, individuals, everything. And in terms of what we promise to our investors, I mean, first and foremost, we're an impact investor, right? So we're not just ticking a box. We're really concerned about impact and actively engage with on three different levels in terms of impacts, in terms of social impact with the companies, the ecosystem, and even regulators where we work. And then beyond that, we offer them what we think is an attractive risk return product financially as well in their space. We obviously can't pay. We're not venture debt providers, so it's not that sort of return. But we think that we can provide an interesting and attractive alternative to some of the other impact investors. And beyond that, it's an open-ended evergreen type product, so investors can come in and out with liquidity at any point. So we think it makes sense for them to diversify with something like our product.
Super. Thank you all so much. We are out of time, and I'm just going to say one final thank you, Gustavo, Yusef, and Bernhard. And for everyone still watching, I just have a couple more things to tell you. So if we can pull up the slides again. And we have been very fortunate today to have Bernhard here from Community Investment Management. Fortunately, they are not the only company out there providing debt to companies. There are a few more on this slide, so feel free to screenshot this and start looking them up. So it's a smaller universe in the debt side compared to the equity side, but a few names here definitely worth looking at. Next week, we are going to be doing our third session, which is going to be about revenue-based financing. So yet another type of non-dilutive capital that you can raise for your company. And for that, we're going to have Sebastian from Seedstars team moderating. We're going to have Rodrigo from New Ventures, Sharda from Grey Matter Capital, and then we're also going to have the perspective of one founder and entrepreneur, which is Samuel from Shamba Pride in Kenya. So that's going to be same time, same place next Thursday, and I hope you can all make it. And for now, thanks all for listening. It's been a really insightful session, and we'll see you all soon. Bye-bye.